Just when you thought all the deals in the stock market were gone, I come at you with this fantastic dividend company that is on a steep discount. I'll even share how many shares of this fantastic company I own at the end of the video. Now, this is a company that provides essential services and has been around for over 100 years. Lowe's is the second largest hardware chain in the US behind Walmart, but ahead of the Midwestern giant Menards. This is a company that offers what every nice home needs in appliances, in flooring, hardware, home renovation, lawn care products, plumbing, home decor, and much more. We're going to be taking a look at their revenue growth, future outlook, valuation, and most importantly, the almighty dividend that Lowe's pays. Over the past 10 years, they went from $51 billion in revenue in 2012 to $93 billion this past year. That to me shows that consumers love Lowe's products and want to do more DIY projects at home. The more time that people spent at home during the pandemic, the more they realized how much of a dump they actually lived in. 50% of homes in the US are over 40 years old and will require upkeep. And that is where approximately 2/3 of the total amount of Lowe's annual sales are generated from. They're generated from the repair and maintenance activity. And this is why Lowe's is so important. With the housing market as strong as it's been, home values are quickly rising. Any sort of a rehab to a house is a surefire way to make it appreciate. Remember, the home improvement sector is a $900 billion total addressable market. They had 18% growth in all product categories in the last 2 years, including building materials, electric, flooring, lawn and garden, lumber, etc. Lowe's also believes that they will drive $100 million in extra productivity this year by having a new store inventory management system. This will show them real-time visibility of the inventory in the store. No more asking if they have another pair in the back, as if the back is this magical place with unlimited amounts of inventory. Lowe's continues to grow its online business and launched its Pro Rewards program. Lowe's studies have shown those with Pro Rewards spend 300% more than non-Pro members. Lowe's also raised their guidance and outlook for the rest of the year, expecting around $98 billion in sales this year, but with the uncertainty that is always the future, they only expect a 1% increase in total sales. But this company does expect a ridiculous $12 billion in share repurchases. That is a guaranteed way to artificially increase your earnings per share and make that share price go up. Lowe's has aggressively been buying back stock over the years. In 2005, they had about 1.6 billion shares outstanding. Today, that number is 1 billion shares less, at just 661 million shares outstanding. That is truly amazing. This means that Lowe's is able to pay its staff and operate its business without the need to dilute shareholders by just creating more shares for cash. I'd say the only thing declining faster than the amount of Lowe's stock outstanding is Will Smith's career. Alright, now for the exciting part, their dividend history. Just make sure you've hit that like button to help out a small-time YouTuber for the algorithm and are subscribed. Lowe's has a very strong track record of rewarding shareholders with dividends. Lowe's has paid a cash dividend every quarter since they've been a public company in 1961. I really like those odds. It shows that this is a durable and recession-proof company. Lowe's is a dividend king with almost 60 straight years of raising their dividend every single year, and Lowe's has a very impressive 18% 5-year dividend growth rate. So not only do they pay out a lot in dividends, but they also give out large pay raises just for being a shareholder. I'm also really impressed with this low payout ratio of just 25%. Lowe's isn't just impressive for being a dividend stock. They have destroyed the market in the past 10 years, returning 667% or 23% annually compared to the market's 287% or 14% annual return in those 10 years. Wow, would we be rich if we had invested in Lowe's over the years. Capital appreciation and high dividends. That is really the best of both worlds. Lowe's has luckily had a little bit of a slump in share price, being down over 10% in the last month alone. It's now trading well below its 200-day moving average of 221 and offers a pretty strong starting yield of 1.6%. But with the dividend growth that this company has had recently, expect that yield on cost to rise quickly. Lowe's PE ratio is now a very respectable 16. And that's exactly why I just had to buy another share yesterday. Now I'm up to a little under $1,000 in equity, or about 4.5 shares. Remember, Lowe's is a newer position in my $117,000 portfolio, so I'm still building it up. But the good news is I'm getting paid about $15 every year right now for just simply holding on to my Lowe's shares. Let me know in the comments below what you think of Lowe's stock. I obviously think they're a great bargain right now. As always, my videos are found in podcast form under the Collect Cash podcast name. Remember to like, comment, and subscribe, and I will buy, stash, and collect cash you later.